Hey traders, it's Matt Stevenson here. How you doing? Want to talk to you about something today that seems counterintuitive, but the numbers don't lie. Everyone thinks prop firms are rewarding consistency. They're not. At least not in the way most traders think. Because if you analyze modern evaluation environments, especially simulated funded account models, you start seeing something strange. Traders with lower win rates are often outperforming traders with higher win rates. Aggressive traders with erratic equity curves are showing up disproportionately on leaderboards. And strategies that traditional risk management textbooks would call unstable are surviving evaluation phases at surprisingly high rates. So what changed? The answer is convexity. And today we're breaking down why high convexity trading strategies are quietly dominating modern prop firm valuation data, and why survival inside these environments increasingly favors asymmetric payoff structures over linear return models. But before we get into it, if you enjoy our content, do us a favor and hit that subscribe button or like button or both, and let's dive in. Most traders still think in linear terms. If I can win 60 to 70% of my trades with controlled risk, I'll eventually succeed. It sounds reasonable. The problem is that prop evaluations are not normal trading environments. They're constrained systems. They imposed hard profit targets, rigid drawdown ceilings, fixed evaluation periods, and nonlinear consequences. And once constraints become nonlinear, optimal strategy selection changes entirely. Let's define the problem. Imagine two different traders. Trader A wins 75% of trades. He risks 100 to make 100. Very smooth equity curve, right? Very controlled, very consistent. Trader B wins only 35% of trades, but he risks 100 to make 500. Very uneven returns. Long periods of nothing, occasional explosive gains. Traditional trading education says trader A is superior, right? Inside many prop evaluations, trader B often has the structural advantage though. Why? Because evaluations aren't asking who is the best long-term portfolio manager. They're asking who reaches a target before hitting a boundary. That changes everything. Mathematically, this becomes a first passage problem. You're essentially measuring which process reaches a target threshold before reaching a failure threshold. And in those systems, the shape of return often matters more than average returns. Convexity sounds complicated, but the intuition is simple. Convexity means your upside expands faster than your downside. So we're talking about profit factor. You lose small and you win disproportionately large. High convexity systems benefit from volatility rather than being harmed by it. Let's use options language for a second, okay? A long gamma position gains increasing benefit as price moves aggressively. Small losses occur repeatedly, but large moves create outsized rewards. Now apply that same logic to trading behavior. High convexity strategies often look like this: small controlled losses, many failed attempts, then one large asymmetric winner. For example, risk 1%, lose 4 trades, down 4%. Then hit a trade returning 8%, 10%, or even 12%. Suddenly the equity curve jumps. The trader isn't depending on high accuracy, they're depending on payoff asymmetry. And that's where modern evaluation structures begin favoring them. Now here's where it gets interesting. Most traders misunderstand tail events. They think tails only mean disasters, but positive tails exist too, right? It's a standard bell curve. There are two sides. Extreme upside outcomes matter. In fact, high convexity traders intentionally seek exposure to positive tail events. They position themselves where rare moves can dramatically accelerate account growth. Because evaluations usually have fixed profit objectives, maybe 8%, maybe 10%, maybe 12%. A trader pursuing linear growth may grind 1%, 0.5%, 1%, 0.8%, slowly climbing, but every trade introduces additional opportunities for error, additional psychological stress, additional exposure to random noise. High convexity traders operate differently. They may stay relatively flat for days. Then one volatility expansion event occurs, a breakout, a catalyst, a liquidity sweep reversal. Suddenly one trade contributes a huge percentage of the target. That entire probability distribution shifts. They're compressing the path length required to succeed, and shorter paths often reduce exposure to cumulative failure. Now, let's explain why leaderboards create the illusion that everyone suddenly became a genius. Suppose 1,000 traders enter evaluations. Most use conventional risk management, moderate reward ratios, moderate win rates, linear returns, but a smaller group uses highly convex systems. Very asymmetric trades, large payoff multiples, aggressive volatility exposure. Most of those high convexity traders fail. Many fail quickly, right? But the few that succeed massively. And because we only observe survivors, we develop survivorship bias. The leaderboard doesn't show the graveyard, it shows the outliers. So people start copying what they see. Huge single day gains, extreme aggression, massive position sizing, and they misunderstand the mechanism. The winners didn't necessarily have magical market prediction. They simply positioned themselves where rare favorable outcomes could create disproportionate returns. I was talking about this with a trader the other day that I coach. We were talking about these contests, these evaluations that people enter, and how the leaders seem to have these massive gains that couldn't possibly have been reached taking normal trades. And we agreed that, yeah, they basically bet it all on black and they hit it. And that's what we're talking about here. Now, before everyone starts thinking, should I just trade aggressively? Not exactly. But because there is a difference between convexity and recklessness increases both upside and downside. It's a double-edged sword. Convexity deliberately limits downside while expanding upside. Those are very different things. A true high convexity strategy still protects account survival. Losses remain defined. Risk remains controlled. Trade selection remains disciplined. The goal isn't gambling. The goal is engineering asymmetry. Professional traders don't ask, how often can I win? They increasingly ask, when I'm right, how disproportionately right can I be? Modern prop evaluations are changing trader behavior because the structure itself creates incentives, and incentives always shape outcomes. The old model of grinding small, consistent gains may still work, but constrained environments increasingly reward traders capable of exploiting asymmetric volatility. The question isn't whether convexity matters. It does. The question becomes whether you understand the difference between engineered asymmetry and uncontrolled risk, because one creates survival and the other creates account termination. And understanding that distinction may be the difference between repeatedly failing evaluations and finally understanding the game you've actually been playing.